Hi, Assalamualaikum warahmatullahi wabarakatuh to Madam Sasia and our fellow friends. We are from Group 6. We present about question 6 regarding creative accounting. Before we start our presentation, let me introduce our team members. We have Juliana Ismail, Nur Asmira binti Aminuddin, Nurul Ashkim binti Muhammad Yazid, and Yusuf bin Abdul Halid. The question is, the accounting process consists of dealing with many matters of judgment and of resolving conflicts between competing approaches to the presentation of the result of financial events and transaction. This flexibility provides opportunities for manipulation, deceit, and misrepresentation. These activities practiced by the less scrupulous elements of the accounting profession have come to be known as creative accounting by Michael Jameson, 1988. Analyze at least 4 motives for creative accounting and support your analysis with relevant theories.
So creative accounting is an accounting practice that adheres to all applicable law and regulations. However, the purpose of this section is completely contrary to the designated objectives of the laws and regulations. So creative accounting exploited the loopholes of financial reporting standards to falsely display a better image for a corporation. Their goal is to alter the statement of the company for various reasons, in which will be discussed later on, and they may occasionally manipulate the reality to achieve that goal. So only the managers who follow the ethical guidelines are less likely to take advantage of the loopholes. The use of creative accounting techniques has grown controversial since it has been linked to some of the world's largest accounting scandals, in the instance of Enron and its auditor Arthur Andersen, which will be discussed later on. So let's first look to the motives of using creative accounting. The first one are the manager's initiative and desire. Top management is usually the one that is most interested in making the company's performance better than it actually is. So if the accounting information about the company's performance is injected into the market will react to the news, provided that the market is a semi-strong market. This will make the reaction of the players in the market wanted to buy the shares of the company. What will happen is, increasing in the demand to buy the shares of the company, while the supply of the share are limited, will result in the increase of the share price. Right? So the manager have interest. So if the managers that have interest of selling the shares will utilize creative accounting to make the share price of the company increase before they sell it to attain maximize capital gain. So the next motive is to achieve targeted performance. There are a few ways the manager can utilize in order to achieve their targeted performance. One of them is overstating revenue and also delaying expenses. What the manager will receive in exchange is easier to get loan. All creditors lend their money in return to get the principal paid together with the interest of the debt. So before the creditor gives the money to the company, they will make a background check and do some research of the company. One of the most simplest way of research is by checking the financial statements of the company. Managers can leverage this by applying creative accounting to make the performance of the company better to increase the chances of getting the loan to finance the project. So the creditor are most likely to give the loan to the company that seems to be more unstable than others because they want to reduce the chances of not getting their return if in the case of the company goes fine up. So unstable company may receive the loan but with a tighter obligations imposed on them, such as debt covenant. For example, the company need to operate with a certain debt to asset ratio. Increasing the debt further will make the company suffer the consequences imposed by the creditor, such as the need to pay back the loan on the spot or legal action taken against them. This will ultimately make the company harder to operate or might even have to let go some of the projects that is potentially benefit to the company in the long run. I will pass on to the next presenter.
Thank you, Yusuf. Now I will continue with the third motive. The entrepreneur operates in a challenging business environment. Its decision-making is influenced by both microeconomic and macroeconomic environment. Therefore, environmental analysis is an important part of the business. as it has a significant impact on the company's market position and defines opportunities and danger. The greatest incentive to use creative accounting is the national tax system. Tax evasion is proportional to the country's economic development and public trust in the government. The willingness to pay tax is influenced by macroeconomic indicators that monitor the stability of the environment or budget deficits, and microeconomic indicators such as competitive environment and resource efficiency. Thus, companies attempt to use accounting policies to reduce profit when they have to face high political costs. Political costs refers to the expenses that certain external organizations may be able to impose on the company, such as the cost of increased tax. The higher a company's political costs, the more likely it is that the manager adopt accounting practices that delay reported earnings from current to future years. For the last motive, I will pass to the next presenter, Juliana.
Thank you, Asmira. I am Juliana. Now I proceed with the last motive of creative accounting, which is pressure from investor. But before that, who is an investor? Okay. The investor is an individual or company or any entity that invests capital with the aim of making a profit. What actually they want after make an investment to a company? Of course, they are interested in financial returns and need to assess the ability of a business to generate net cash inflows. So, from the perspective of investor, either existing or potential, they want to look the key performance of company. This is an indicator for them to see in the company's financial statements before they will invest or proceed become shareholder in our company. Business financial statements are like a financial report card showing how well your business is doing. Therefore, mispresentation of financial statements can also occur in an effort to attract as much as possible the number of investors and thus secure the demand for equity market shares. Potential investors and capital market participants expect a steady rise in profits, which encourage the companies to misinterpret the economic result and show overvalued profits. In this way, company can achieve better economic results than other companies. To be successful and remain in business, both profitability and growth are important and necessary for a company to survive and remain attractive to investors and analysts. Profitability is, of course, critical to a company's existence, but growth is crucial to long-term survival. Okay, next, the theory that can relate to this last motive is the efficient market hypothesis theory. This also has been explained by Yusuf, but how it can relate to the investor? First, we must understand the capital market research. It assesses the aggregate effect of financial reporting on investors. Other than that, capital market research only look at the share price, and the share price only refers to the reaction by investors. It ignores reactions of other users such as bankers, suppliers, or customers. Next, as we all know, the investors find financial information to be useful, so they will react either by buying or selling the shares. Investors as a users of the company will look at the accounting information and either make a decision to buy. If they make a decision buy shares, a lot of people make a decision to buy, then the share price will go up because there's a lot more demand. Capital markets research explores the market's reaction to various releases of information, including accounting information, and therefore capital market research should be of interest to the accounting profession. In relation of EMH theory, capital market research relies on the assumption equity markets are efficient. If markets are efficient, they will use information from various sources when predicting future earnings. If accounting information does not impact on the share price, then it is deemed not to have any information value above that currently available. Okay, now let's move on to the common technique used for creative accounting. Firstly, off-balance sheet financing. It can be defined as an accounting strategy that companies use to move certain assets, liabilities, or transactions away from their balance sheets. Off-balance sheet financing techniques are much more advanced and demanding to recognize. A much broader qualification and experience in the art are then necessary in this technique. This technique is mostly linked to covering the financial risk and aims to eliminate the risks arising from the indebtedness and solvency of the company. These are economic transactions planned in advance, and their main objective is to distort profit. They aim to find a way of financing that does not appear as a liability but causes the company to have funds from outside sources. For example, case is Enron. Secondly, cookie jar reserves. It refers to savings from previous quarters that a company records as earning in subsequent quarters to make it appear that its earnings were higher than they really were. When a company fails to fulfill its earning target, an accountant might use the cookie jar to inflate the figures. Cookie jar misleads investors and violates accepted public company reporting practice. The example case for the cookie jar technique is Dell Company. And lastly, real earnings management. It attempts to manage cash flows and thus the revenue and expenses associated with operations. This involves manipulating real transactions to alter reported earnings by designing them in such a way that the desired result can be obtained. Examples of this technique include reducing prices, changing production, discretionary expenditures, including R&D and SG&A, selling general and administrative expenses, and debt equity swaps. Okay, next, let me explain a little bit of cases that I have mentioned just now. First is Enron's case. For the purpose of hiding huge debt loads, Enron considered using Special Purpose Vehicle (SPV), a type of off-balance sheet financing. The firm used its cash and notes arising from SPV for trading its rapidly increasing stock. The Special Purpose Vehicle (SPV) utilized stock so as to hedge assets recorded on the balance sheet of Enron. And with the reduction in the company's stock, the worth of special purpose vehicles also decreased, and Enron was held liable for being in their favor. The company went bankrupt, and it was beyond Enron's reach to pay back its investors and creditors. Even though the company mentioned about SPVs in the notes of the financial statements, most of the investors were not able to catch the intensity of the situation. Okay, next is Dell's case. This is one famous case of cookie jar accounting ended with the computer giant Dell paying $100 million penalty to the Securities and Exchange Commission (SEC) in July 2010. The SEC argued that Dell would have missed analyst earnings estimates in every quarter between 2002 and 2006 had it not dipped into its reserve to cover the shortfalls in its operating results. In this case, the cookie jar reserves reportedly consisted of undisclosed payments that Dell received from chip giant Intel in return for agreeing to use Intel's CPU chips exclusively in its computers. The SEC also alleged that Dell did not disclose to investors that it was drawing on these reserves. In fact, the Intel payments made up a huge chunk of Dell's profit, accounting for as much as 72% of its quarterly operating income at their peak. Dell's quarterly profits fell significantly in 2007 after the arrangement with Intel ended. The SEC also alleged that Dell claimed that the decline in profitability was due to an aggressive product pricing strategy and higher component price, but the real reason was that it was no longer receiving payments from Intel. Okay, that's all from me. I will pass to the next presenter, Asmira.
Thank you, Juliana. There are many examples of creative accounting, and one of them is loan. The company might lend money to someone connected to the business. There may also be an attempt to conceal this transaction from the account readers. One option in this situation is to set things up so that the borrower repays the loan shortly before the period ends. Then, at the start of the next quarter, a new loan in the same amount appears. The second example is property or fixed asset valuation. On the balance sheet, certain item of property or fixed asset must be presented at fair value. The purchase price and fair value may differ. However, a firm can legitimately revalue the property to increase the amount. By being over-optimistic with the property's revaluation, management can twist the company's apparent financial health. Lastly is invoicing. To inflate its sales figure, a company may send its client an invoice before the end of accounting period, but deliver beyond that period. It is an example of a firm attempting to show boosted up sales and profit. Thank you. I will pass to the next presenter.
Alright, thank you Asmira for the good explanation. Now let's move on to the advantages of creative accounting. On the positive side, creative accounting helps large corporations smooth out their income patterns in order to avoid attention from authorities and lobby groups with political agendas. Companies dealing with volatile markets, such as oil companies, may use creative accounting to smooth out erratic results in order to avoid alarming their investors. Plus, companies that require financial assistance may use accounting policy to achieve low debt ratios and high profit margins. The company's growth graph can be smooth and steady. To attract investors, management use this technique to demonstrate consistent profit and high revenue. Investors can be encouraged by seeing future gains in the company's budgeted account. This is how a company that loses money can benefit from creative accounting. Lastly, by using this method, the company can conceal some of the financial risks that they may face. Earning management or creative accounting may be used by managers to communicate inside information to investors. In this case, it can help with financial reporting.
Thank you, Ashikin. Although creative accounting is an ethical practice, sometimes it can be treated as illegal. When the values of the books of accounts of the firm are unethically or illegally misrepresented, then it can call for some qualifications. Creative accounting can mislead investors by untruthfully reporting financial information of the firm in a favorable light. The manipulative practice often called as cooking the books. The company will always be at high risk of losing its investors because if the investors figure out what is going on, it will be a disaster for the company. The investors' interest may be endangered. Next, in the long run, if it is revealed the company engaged in creative accounting, the client expectation of the company will be jeopardized. The company will lose business and its hard-won reputation. The profession also lost its reputation in the public. Lastly, the overnight collapse of a corporate giant like Enron affected the investors' confidence toward the capital market. That's all from me, thank you. Now, I will pass back to Ashikin.
So now let's move to the last part of our presentation, which is method to prevent creative accounting. Companies with weak internal controls, no audit committee, a family relationship among directors or officers, and little experience serving as director of other companies are more likely to engage in fraudulent financial reporting. Experts believe that accountants and managers should divide the duties of an internal control checklist to prevent creative accounting. Someone with a strong accounting background and audit experience who deals directly with outside auditor should always be an independent audit committee. Investors should diversify their investment portfolio to avoid problems caused by a few unethical companies' creative accounting. Even though external audit do not completely prevent unauthorized creative accounting, but external auditors with extensive experience are often more capable of detecting it. Even if auditors do not always detect creative accounting, external audit as a standard practice frequently act as a psychological deterrent. The company must also strictly adhere to the ethical values it has established for both the long run and the short run of the company's life. Accounting and accounting practices must be consistent and demonstrate to investors that the companies follow ethical practices in all financial transactions and reporting. And lastly, formal policies and penalties for creative accounting serve three functions. On one level, they make it clear to new employees that the company does not support such practices. Formal policies and penalties serve as a mechanism for correcting the behavior of employees who violate the policy by imposing some form of punishment. Direct repayment, for example, solidify the business position on the matter if an employee did not believe in the authenticity of the prohibition on creative accounting. Formal policies and penalties can also be used to fire an employee if he continues to engage in creative accounting practices after receiving less punishment. So the conclusion is, the company's financial statements serve as an information base for internal and external users. Their main task is to give a true and faithful picture of the company's financial situation, its performance and changes. Managers are responsible for publishing this information, and they are most motivated to mispresent data according to their ideas. This tries to improve the image of a company in the eyes of the public. However, by doing this creative accounting, it may cause more harm than benefit to businesses. This strategy can only assist in the firm in attaining its short-term objective rather than strategies to become more sustainable in the sector. So that is all from us. Thank you.